I do think that it's a good sign that inflation numbers are turning, but I don't think we're out of the woods yet. Anna Stupnytska, Fidelity International. According to Reuters, the Brexit-induced fall in the value of the pound, which hit an all-time low against a range of currencies on Wednesday, will increase the UK's inflation rate. The only question is by how much. Anna, do you agree? And do you think this will be reflected in September figures due to be released this Tuesday?
I definitely agree that the fall in the pound that we have seen since the Brexit referendum and even before that will start pushing up inflation as we move into the next year. I think that the inflation should rise somewhere between 100 to 200 basis points relative to where we are now. So we are looking for inflation to meet the Bank of England target of 2% sometime in 2017 and likely to overshoot that target and peak sometime in 2018. Of course, it depends on further moves in the currency, but if we look at the current levels, we have seen about 16% fall in the trade-weighted sterling since the referendum and about 30% fall since the end of last year. So roughly year to date, we've seen a 30% fall in the trade-weighted value of the sterling. So that could significantly push inflation from current level higher.
Also on Tuesday is the US inflation rate. New York Fed President Bill Dudley said that US inflation expectations seem to be well anchored. However, he believes the rate may be below expectations, which currently sits at a gain of 1.5%. What is your opinion on the outcome of the data?
In the US, we are also starting to see the upward move in inflation, more so on the headline, which is expected to come at 1.5% versus core. Core is still relatively slow moving and roughly flat for now. And the reason why the headline inflation is rising is because of the base effects from commodity prices. We saw a collapse in commodity prices since mid-2014 and then a pickup through 2016. So as we approach the end of the year, inflation should start picking up on the back of this base effect. The core has been held down partly by low commodity prices, but also by the strong dollar that we had seen for the last couple of years. Now that trend has reversed partly, so the dollar is now weaker and the labor market is now tighter than before, and I think these are the two big forces that will start contributing to a gradual rise in core inflation in the US over the next couple of quarters.
According to economists, China's economy is on the mend, which was reflected in inflation figures published last week. Firstly, do you agree? And do you think the country's GDP data, due to be released on Wednesday, will continue to show strong results?
I think it is a good sign that Chinese inflation started rising and crucially the producer price inflation has turned positive for the first time in many months and years. But again, I think that is something that is driven by mainly by commodity prices that have bottomed out and started picking up. And also, of course, this year we have seen a really big fiscal and monetary stimulus in China that was introduced at the beginning of the year, which has had a positive impact on growth, demand, and inflation. So I think this is largely a result of that. As we look into the end of this year, I expect this stimulus to be withdrawn gradually. So the withdrawal of the stimulus in China probably means that we will see a slowdown towards the end of this year, the beginning of next year, and that could in turn again have a downward impact on inflation. So I do think it's a good sign that inflation numbers are turning, but I don't think we're out of the woods yet. and we're still on that trajectory in China where growth should be slower and the economy should be rebalancing towards consumption.
Thank you for joining us today, Anna. That's all for today's Week Ahead, but stay with us here on Dukascopy TV for plenty more.